Hello, I'm Marianne Deveni. Well, markets are moving lower, and we've seen small caps actually had an official correction, dropping more than 10% since their peak in early July. The rest of the market looks headed in the same way. So is this the long-awaited correction, or is there a bigger problem going on with global growth? Well, I'm talking today with Michael O'Brien, who's portfolio manager of the TD Canadian Equity and Canadian Blue Chip Equity Funds. So Mike, it's been lots of red, you might say, not just a little bit, but a lot of red. What's going on?
Well, I think we've had it pretty good for quite a while here, Marianne. So if you think about it, we've been softened up a little bit. We're not used to the choppy markets. I don't think this is anything out of the ordinary. I don't think this is anything unexpected. I think this is just part of the rhythm of the market. Coming into September, I think we were up 27% over a one-year period.
Which is pretty huge.
Pretty solid returns. We've given back 5, 6, 7%, depending on which market you're looking at in the last month. But that's not the end of the world. We're still it's still been pretty good markets.
So we were up almost maybe too high over the last while, and we haven't had a correction in quite some time, over a year at least.
Yep.
So this is kind of is what you're thinking.
Yeah. Well, I think. It's interesting today, people are going to point to a lot of different things as why this is happening. Is it about Ebola? Is it about what's going on in the Ukraine and Russia? Is it about Europe and the ECB? I don't think it's any one thing. I think really it's just, these were really trigger events or pretexts for something that was eventually going to happen anyway. And so to your point, I think that's exactly what happened is the market had it pretty good for quite a while. People were feeling good about themselves. Sentiment was very positive. Valuations probably got a little bit ahead of where they should have been. And I was kind of thinking about this. It's almost like if you're in great shape, if you're healthy and feeling top notch, if there's a flu bug going around or a cold, usually you can shrug it off. When your immune system's down a little bit, if you're feeling a little run down, that's when you're vulnerable. That's when you pick up these bugs and you can't seem to shake them. I kind of think that's, you can think about the market in a similar way. The first Ebola case came out, in February or March, but it didn't bother the market until just a couple of weeks ago. A lot of these other things, they've been brewing beneath the surface. A little while ago, it was the Scottish referendum in the UK, and people were worried about that. Markets shrugged it off. I think it's just a case where because the valuations got a little ahead of the fundamentals, the market was in a bit of a vulnerable state. Its immune system was down, and now it's caught a bit of a cold and has to shrug it off.
Yeah, and we're having global growth and some of the economic stats that have been coming out of particularly the U.S. Not maybe everywhere else, but has been fairly half decent, fairly good numbers. But we seem to have people maybe changing their portfolios around a little bit, being that we're now to the end of QE. It's officially October, so this will be the end of it. And do you think people are repositioning their outlook for the coming year, quarter?
Yeah, I think that's definitely all part of it. And, in a couple different respects. In one respect, I think people are doing the sensible, responsible thing, which is they're taking a look across their portfolios and they're taking little profits from some of the winners that have run very hard, looking to potentially rotate into some of the laggards. That's a very healthy, normal part of it. There could be some dislocations as well as people start thinking through the implications of what does it mean that the Federal Reserve isn't going to have interest rates at 0% forever? It's been 5 years now, 5.5 years since they put rates at zero. So whether it's 6 months from now, whether it's 9 months from now, at some point in the not too distant future, that's going to change. And so obviously that's going to trigger a few different reallocations as well. So I think it's all part of the mix.
So where do we go from here? We've almost been the last 5 years trying to consolidate, find our footing again. Where do you see it going from here?
I think that's a great way to phrase it, actually. I think that's exactly what we have done is, sometimes we forget just how bad it was back in 2008, 2009. Then we look at our battle scars and realize, no, it was pretty bad. I think, broadly speaking, we've done a pretty good job of consolidating that. And particularly when you refer to the North American economy, and I agree with you 100%, while you get the odd, questionable or, weakish-looking piece of data out of the U.S. or Canadian economy, by and large, things look pretty solid. So I think to answer your question, where do we go from here? I think we go higher. It's just we don't go in a straight line up. The Wealth Asset Allocation Committee has been talking for a long time now about a view of a low growth, low return world. I think it's not no growth, no return, it's low growth, low return, and I think that's what we should expect is more moderate returns over the next, 12, 24, 36 months.
So where do you look then when you're investing in this type of a market, or even right now?
Yeah. Well, I think right now, these, call it a correction, call it what you will, these types of events take on a life of their own. Mm-hmm. And so I think the smartest thing I can do and the smartest thing most people can do is just step back for a second, do nothing. Just watch and,
at least think.
let it play itself out. And then as we get more information, reassess and, say, okay, the fundamental positioning I had and the stocks that I owned, has something fundamental changed that I need to completely revisit this? Or was this really just a buying opportunity that gives me a chance to buy more of what I already liked? I'm in the latter camp. I'm thinking of this more as we'll let this play out, and then you start to look at where value has reappeared. Because if you go back to May, June, July of this year, value is getting very hard to come by, especially for the good quality companies. Today, before I came over here, I was looking through my portfolio and some of these names. I'll rhyme off a whole list of names. So you had Suncor and Canadian Natural Resources in the energy space. You had Magna in the consumer discretionary space. You have all the banks, all the insurance companies. You look at a big US technology company like Oracle. All of these companies are trading between 10.5 and 12 times next year's earnings. Like, that's value. Mm-hmm. These are real companies with real businesses, real free cash flow, and they're trading at very moderate multiples. So I think with that as the backdrop, the view of where markets are heading should be a positive one, unless we've really got the global growth story wrong. And that's the single biggest risk. So take a breath, step back, see what kind of data comes in terms of, the global economy. Does it begin to find its footing and stabilize? If so, then I think we're in good shape.
All right. Well, we'll keep watch and keep everyone posted. Thank you very much, Mike.
Pleasure to be here.
I've been joined by Mike O'Brien, who is portfolio manager for the TD Canadian Equity and Canadian Blue Chip Equity Funds. Thanks for watching.